right, guys, we got a pretty exciting one today. We're going after one of the newest blue chip stocks. It's Palantir. Been really exploding recently, so we're gonna go ahead and take a look at the financials, see how it's looking for the future.
Cool. So we've got our spreadsheet here, and then we're gonna come to Google, just type in Palantir 10K. It'll take us to their website, and then we can select the annual reports and then filter by year. So we've already pulled these up. So we basically have the years 2020, 21, 22, 23, 24, and then we're going to segment our spreadsheet by the way that they have done theirs. So we have revenue, nothing under revenue, and then it goes straight into cost of revenue, getting into profit, operating expenses, and then all the different operating expenses eventually leading to net income. So we can see that we've set up ours the same way. And so we will get into some of the numbers here. So we can start typing these in, and I'm just going to pull up my spreadsheet here, and we're going to zoom in a little bit, make it a little easier to see. And then we've already populated the numbers on another tab, so just going to go ahead and populate these in this one. Pretty easy there. Cool. So let's take a look at what we have. So we got revenues over the past 5 years. You can see they are going up pretty steadily. So definitely a good sign. Almost doubling there from 1 million to 3, or sorry, tripling from 1 million to 3 million. Cost of revenues likewise going up, but still not as close. So that's going to give us a pretty decent profit margin there. And especially last year, almost 2.2 or 2.3 million worth of profit. So that's pretty awesome. Getting into the operating expenses, we can just see the different line items that they've done: sales and marketing, R&D, G&A. So total operating expenses have actually gone down a tiny bit since 2020, but then last year, a little bit of a jump up. So we'll see that operating income here. Actually pretty interesting that revenues minus expenses giving us this operating income here was negative in 2020 and 21, but then it's increased quite a bit over the last 3 years and is now positive and is really growing quite a bit. So that's definitely a good sign. And I'm sure that's going to affect the net income down here below. So we can see just the different interest and mostly interest expenses down here. And this is going to lead to the net income. So like I was kind of expecting, the net income is negative over the last couple of years, going back to 2020. And then as we get closer here to 2024, the net income is finally starting to turn around and gets positive here. So definitely a good sign. And I think that will be reflected later on in the expected share price. We should actually be looking a little bit farther down here because they do have a line item for the net income attributable to non-controlling interest. So we have to subtract those out. So that's going to give us our actual net income, which still pretty similar, negative, trending towards positive. So definitely a good sign there. We have our operating margin, which just because the operating expenses are so high relative to the revenues, it is quite large, but then shrinking a bit there. And then pretty similar with the earnings per share. We have a negative earnings per share growing into positive in recent years. So that's definitely good. And then shares outstanding, it looks like back in 2021, they issued quite a bit more, about 1 million more, and that continues to grow. So coming down a bit more to the final part of this page, the percentage of sales. So we can populate this here. And just going to take a look at some of these different line items. So we have depreciation and amortization was negative, kind of trending towards the positive direction. CapEx, kind of all over the place, goes from negative to positive. I assume they're just kind of making some purchases, whether it's new buildings or not totally sure, but it does just give us a sense of what they're spending some of their money on. Receivables, pretty large negative numbers. No inventory, just given the nature of their business. And then payables as well, mostly negative here. So that's ultimately going to give us a working capital that does seem to be kind of all over the place, from some smaller positive numbers, bigger negative numbers, and then up to bigger 117K. So projecting those out, you can just kind of see what those look like. So let's get into the discounted cash flow. So on this page, getting into the discount rate and growth rate, I feel like there were a lot of split answers on what numbers should be used here just based on my research. So I ended up going with a 10% discount rate, which is a bit higher, and then a 4% growth rate. They have seen some pretty crazy growth over the last couple of years, but this is the terminal growth rate, so don't want to get too high there, kind of being a little more realistic around that 4%. But we can obviously change those a bit and see how it looks. So just looking at the revenue here, we are increasing quite a bit. You can just see over these future kind of 3 years, it's growing around like 30, little over 30% based on our projections from the previous page. And then once that 4% kicks in, you can see it's more steady, but still growing pretty steadily and in a good spot there. Operating income pretty similarly, growing pretty steadily. And then of course, the interest income before taxes, those are similarly growing at a pretty steady rate, although I know this is always the big jump once we go from the projections on the previous page to actually incorporating some of the numbers on this page. So this is referencing the previous page, and this is referencing a new formula here. So always a big jump there, but that'll play a big part in the net income here, as well as the free cash flow. So pretty big change, but gets into more of projecting out the next 10 years. And so as we move towards wrapping up here, you can just see the net present value of those cash flows, the net present value of the terminal value, which of course the terminal value is over here using these discount rates that we've selected. So just going to give us a picture of where things will be shaping up in about 10 years. And so now we will type in the debt, cash, and shares outstanding. So coming to 2024, the cash is going to put us at 2,098,524, and then cash, or sorry, that was the cash. Should put that down here. And then the debt, that is going to put us right here at 6,340,884. And then of course, shares outstanding, approximately 255. And so with our share price of 154 or 157.04, that will give us an implied value of 284 with an 81% upside. So that's pretty huge. We're really just projecting a lot of growth over the next couple of years. And so looks like it could be a buy decision. I know a lot of people are saying to hold, which you can see on the screen. Some people are saying buy, some are saying sell. So I think there's going to be a lot more factors that go into this than just the numbers. But yeah, just based on the numbers that we have here, looks like it could be a buy. So lastly, what I like to do is just perform a bit of a sensitivity analysis and just see what would happen if we change these discount and growth rates. So can come down here, and to get this started here, we'll put the implied share value. And then on this side, we can put the possible discount rates. So say we want to start with 6%, we'll do 6.5, 7. So we'll drag that out a bit. And then say we want to start with, how about 0, 0.3, 0.6. We will drag that down. So if we want to highlight this whole area, then we will come up to data, what if, data table, and for the row, we'll do the discount rate, the column will be the growth rate, and we can see how these turn out. So we'll make this a dollar format. And then just to read it a little bit better, if it's greater than this actual price, we'll make it green. If it is less than the actual dollar price, we will make it red. Alrighty, so looks like most of these scenarios are going to come up with still being better than the implied, or sorry, the current share price. Once we get into a discount rate, and we can actually put this up here just to help read it a bit better, growth rate. So these discount rates getting up to 10.5, 11, 11.5 with a growth rate down here below 1, that's when we start to see this actually looking into a sell. So overall, does look like based off our financials and our projections, it's going to be a buy in most circumstances. But yeah, how fascinating is that?
Awesome. I am personally excited to see where this one goes. I feel like they have a great leadership team and just in an interesting space. So, yeah, we'll see how that turns out. Thanks for tuning in.